The 2025 stock rally wasn't saved by luck. It was saved by data, chips, and trillions poured into artificial intelligence. Today, the Magnificent Seven's record earnings just rewrote the entire market narrative, and the S&P 500 responded by breaking history. Welcome to Smart Money Sense, where we turn market chaos into strategic clarity. I'm here to break down the three forces that just pushed Wall Street to all-time highs, and why your portfolio's future might depend on understanding what happened this October. On October 24th, 2025, something remarkable happened. The S&P 500 closed at 6,805.71, marking its first close above 6,800 in history. The Dow Jones Industrial Average soared 473 points to close at 47,207, smashing through the 47,000 barrier for the first time ever. And the Nasdaq Composite surged 1.15% to 23,236. But here's what most headlines miss. This wasn't just another bull market day. This was the convergence of three massive financial forces that individually would move markets, but together created what Goldman Sachs traders are calling the most favorable setup they've seen in years. The first force? Earnings. Not just any earnings, but a complete divergence between America's tech titans and everyone else. The Magnificent Seven, that's Microsoft, Apple, Nvidia, Alphabet, Amazon, Meta, and Tesla, are growing earnings at 14.9% year over year this quarter. Meanwhile, the other 493 companies in the S&P 500? Just 6.7% growth. That's more than double the growth rate, and it's creating a two-tiered market that's impossible to ignore. Let me put this in perspective. Microsoft, with a market cap of $3.86 trillion, is expected to report earnings per share of $3.11 on revenue of $64.5 billion. Their Azure cloud services are growing at 39% year over year, driven almost entirely by artificial intelligence workloads. Apple, valued at $3.82 trillion, hit record highs during this rally despite concerns about iPhone sales. Nvidia, the crown jewel of the AI revolution, now carries a market cap between $4.36 and $4.5 trillion. Think about that. Nvidia alone represents over 7% of the entire S&P 500, carrying as much weight as the bottom 224 stocks combined. Now, if you're watching this and thinking about your own investment strategy, drop a comment below. Tell me, are you overweight in tech right now, or have you been diversifying into other sectors? Because what I'm about to show you next will help you decide if that's the right move. Alphabet is expected to report $99.75 billion in revenue with earnings per share of $2.29. Google Cloud just exceeded a $50 billion annual revenue run rate. Amazon, at $2.32 trillion in market cap, is seeing AWS cloud revenue grow 17% year over year, while their advertising business jumped 23% in the second quarter. Meta Platforms is projecting $49.4 billion in revenue, representing 21.6% year-over-year growth. Their AI-powered advertising is delivering 5% more conversions on Instagram and 3% on Facebook. That's not just growth, that's monetization at scale. But then there's Tesla, and Tesla tells a different story. While the other six are riding the AI wave, Tesla reported $28.01 billion in revenue, but missed earnings expectations with 50 cents per share versus the expected 54 cents. This marks their fourth consecutive quarter of earnings contraction. Tesla reminds us that not all Magnificent Seven stocks are created equal in this rally. The combined market capitalization of these seven companies now exceeds $19 trillion. They represent over 30% of the S&P 500's total market cap. For anyone holding an S&P 500 index fund, approximately 40% of your investment is tied to the performance of just 10 companies. That's concentration risk at historic levels. The second force driving this rally? The Federal Reserve's monetary policy pivot. After months of restrictive policy, the Fed cut rates by 25 basis points in September 2025, bringing the federal funds rate to 4.00 to 4.25%. This was the first cut since December 2024, and it signaled a fundamental shift in the Fed's approach. But the real catalyst came on October 24th, when the September CPI report was finally released after being delayed 10 days due to the government shutdown. Inflation came in at 3.0% year over year, below expectations of 3.1%. The month-over-month increase was just 0.3%, also below forecasts. Core CPI matched at 3.0% year over year and 0.2% month over month. This cooler-than-expected inflation data did two things. First, it validated the Fed's decision to cut rates. Second, it cemented market expectations for two additional cuts before year-end. Current market pricing shows a 99% probability of another 25 basis point cut at the October 29th Fed meeting and a 71% chance of a December cut. Jerome Powell characterized the September move as a risk management cut designed to prevent further labor market slowing. But the question everyone's asking is whether this marks the beginning of an extended easing cycle or just a brief pause in the fight against inflation. The answer to that question will determine whether this rally has legs or runs out of steam. Now, before we dive into the third and most important force, I want you to hit that subscribe button and turn on notifications. Because the AI spending story I'm about to break down isn't just moving markets today. It's reshaping the entire structure of the American economy, and you need to understand it to position your portfolio for the next 5 years. The third force, and this is the big one, is the artificial intelligence capital expenditure explosion. In fiscal year 2025, the four largest cloud players, Amazon, Alphabet, Microsoft, and Meta, are investing a combined $364 billion in capital expenditures. That's up $39 billion from 2024, representing 12% growth in AI-related infrastructure spending. But here's what makes this unprecedented. This AI spending contributed 1.1 percentage points to U.S. GDP growth in the first half of 2025. That means AI infrastructure investment is contributing more to economic growth than consumer spending during the same period. Let that sink in. The backbone of the American economy is no longer just consumer purchases. It's data centers, GPU chips, and cloud computing infrastructure. NVIDIA CEO Jensen Huang estimates that AI infrastructure spending could reach $3 to $4 trillion by 2030. But here's the catch. To justify that level of investment, companies need to generate nearly $2 trillion in new annual revenue. That's the critical question facing this market. Can these companies actually monetize their massive AI investments, or are we building towards another tech bust? Microsoft is planning $80 billion in AI infrastructure investment. Meta is projected to spend between $64 and $72 billion on AI-related infrastructure. Amazon expects to invest over $30 billion per quarter in CapEx for the next 2 quarters. Alphabet is planning to reach approximately $85 billion in capital expenditures for 2025. The cloud infrastructure market reached $98.8 billion in revenue in the second quarter of 2025, up over $20 billion, representing 25% year-over-year growth. AWS generated $30.9 billion in quarterly revenue with 17.5% growth. Google Cloud hit $13.6 billion with 32% growth. Azure is estimated at $18 to $20 billion with 39% growth. Global AI spending is forecast to reach nearly $1.5 trillion in 2025, according to Gartner. By 2026, that number is expected to grow 40% to $2 trillion. Citigroup projects that big tech's AI infrastructure spending will surpass $2.8 trillion through the 2029. This is creating what analysts are calling a virtuous cycle for the Magnificent Seven. Their core businesses generate enormous free cash flow. That cash gets funneled into massive AI infrastructure buildouts. That spending creates technological barriers that startups and smaller competitors simply cannot overcome. They control the full stack. NVIDIA makes the chips, Microsoft, Amazon, and Google operate the cloud platforms, and Meta and Google develop the AI models and applications. But, and this is critical, several top financial leaders are issuing stark warnings. Jamie Dimon, CEO of JP Morgan Chase, stated that there are numerous assets that appear to be approaching bubble territory. That doesn't imply you can't see another 20% increase, but it adds another layer of concern. Lisa Shallett, Chief Investment Officer at Morgan Stanley Wealth Management, warned that the market is entirely rooted in this one story about AI infrastructure. She noted that AI capex contributed an estimated 100 basis points to second quarter GDP growth, outpacing consumer spending by tenfold. Her concern? At some point, we're not going to be building any more data centers for a while. After that, it's just a question of whether you crash. Bank of America's Global Fund Manager survey identified AI equity bubble as the foremost tail risk for the first time in the survey's history. Cash levels among fund managers declined to 3.8%, approaching Bank of America's sell signal threshold of 3.7%. The S&P 500 now trades at approximately 23 times forward earnings estimates, well above the 10-year average of 18.7 times. Current valuations are approaching levels seen during the internet boom 25 years ago, according to IMF Managing Director Kristalina Georgieva. So, what does this all mean for your portfolio? Let me break down 3 scenarios. The optimistic scenario: the current rally is just the beginning. The Fed continues cutting rates, Magnificent Seven earnings consistently beat expectations, and the massive AI investment unlocks a new era of productivity growth, similar to what we saw with the internet in the 1990s. In this scenario, the S&P 500 breaks 7,000 in 2026. The realistic scenario: the rally continues into early 2026, driven by momentum and fear of missing out. However, growth begins to moderate as capital expenditures peak and valuations face pressure. The market experiences a healthy 10 to 15% correction, but avoids a crash as the AI story remains intact, albeit with a more realistic timeline for monetization. The pessimistic scenario: a bellwether like Nvidia or a major cloud provider reports slowing growth or warns that AI revenue isn't materializing as quickly as hoped. This shatters market confidence, bursting the AI bubble. The tech sector sees a 30 to 40% decline, mirroring the dot-com bust, dragging the broader market into recession. Which scenario unfolds depends on the earnings reports coming this week and the guidance provided for the fourth quarter and 2026. Pay close attention to what Microsoft, Alphabet, Meta, Apple, and Amazon say about their AI revenue trajectories, not just their spending plans. For current shareholders, this is a time for active portfolio review. The key decision is whether to rebalance and take profits from highly concentrated, high-valuation positions, or to stick with the let your winners run philosophy, betting that the AI secular trend is still in its early innings. Look for warning signs: any sequential slowdown in AWS, Azure, or Google Cloud growth rates. Negative guidance from any Magnificent Seven company. Widening credit spreads indicating increased risk aversion. And watch insider selling levels among top executives at these tech giants. The 2025 rally wasn't luck. It was a perfect storm of record tech earnings, accommodative Federal Reserve policy, and historic AI infrastructure investment. But with the Magnificent Seven now representing over 30% of the S&P 500 and valuations stretched to levels that invite comparisons to the dot-com era, the next chapter will determine whether this is the beginning of a generational technology transformation or another bubble waiting to burst. This is Smart Money Sense, helping you read markets before they read you. Subscribe for clarity in a confusing world, because when data meets emotion, strategy wins. I'll see you in the next breakdown.